Fraud is defined as a crime committed with the objective of benefiting the participants, which involves deception or misrepresentation, as well as concealment or distortion of facts. The definition of fraud in nearly all jurisdictions and by monitoring groups involves a crime committed through deception, which distinguishes it from other forms of theft or embezzlement. By committing a fraudulent act, a person acts dishonestly and intends to make a gain for themselves or someone else, which causes loss to the victim or exposes the victim to a risk of loss. In the UK, the Fraud Act 2006 and the Theft Act 1968 outline the primary fraud offences. A similar outline of offences exists in legislation such as the companies and tax regulations, and the landscape continues to evolve. The UK hosted an anti-corruption summit in 2016 and enacted the Criminal Finances Act in 2017. Some offences outlined in these acts include fraud by false representation, failing to disclose information where there is a legal duty to disclose it, and abuse of position, by which the person acts against the interest of a person they should be instead safeguarding. Fraud then involves deliberate and deceptive acts, such as forgery of any document, with intent to obtain benefits such as money, property, or services. Misrepresentation could be false presentation, concealment, or non-disclosure. There are typically 4 elements involved in any fraud case. A materially false statement, that is, made deliberately in the knowledge that it is false and where. Reliance on the false statement by the victim, which results in damages to the victim. The victim could be a person or it could be an organisation. Corruption is worth considering here, as it often spoken of alongside fraud, but the two are different.
It is generally estimated that companies worldwide lose about 5% of annual revenue due to fraud. In industries where margins are thin, this can mean the difference between a business showing a profit or a loss. In addition, particularly for companies which are under pressure to show expansion, this can determine whether a company is growing and attracting investment or appearing to stagnate. According to PwC's 2022 Global Economic Crime and Fraud Survey, 46% of organizations reported experiencing fraud, corruption, or other types of economic crime in the past 24 months. This represented a slight drop from 47% in 2020. The 3 most prevalent types of financial crimes were cyber-enabled fraud, customer fraud, and asset misappropriation. The severity of the various types of fraud differs by industry. In the energy, utilities, and resources industries, procurement fraud was the top risk. In prior surveys, customer fraud was the #1 risk across the widest range of firms, but in the latest report, cyber-enabled fraud and cybercrime more generally is now the biggest danger and was the top for government and the public sector, healthcare, industrial manufacturing, and technology, media, and telecom. It is important to understand, however, that all types of firms are susceptible to cyber-enabled fraud. Customer fraud is still the top risk for financial services, 44% of firms reporting incidents, and also for retail and consumer businesses. While knowing the most common types of fraud can help organizations prepare for the worst, awareness of the most frequent perpetrators can instruct companies and other types of organizations on where to focus their attention. In the PwC report, the top external perpetrators were hackers, 31%, customers, 29%, and organized crime, 28%. Another interesting detail is that for small and medium firms, cybercrime was the top risk, while very large firms with global revenue greater than $10 billion reported customer fraud as their biggest issue.
Most fraud can be classified into 3 categories, each with further subcategories. This is explained in the fraud tree. The fraud tree is a taxonomy of fraud developed by the Association of Certified Fraud Examiners, ACFE, a private association in the US. The 3 categories are fraudulent statements, financial and non-financial, asset misappropriation, taking cash, inventory, or other assets, billing for non-existent materials or work, payroll for non-existent employees, corruption, doing something with the intention of obtaining an undue advantage. Corruption often occurs when fraudsters wrongfully use their influence in a transaction to benefit themselves or another party to whom the benefit is not due, often through conflict of interest, bribery, illegal gratuities, or economic extortion. The types of fraud listed above are not exhaustive. Any similar or related inappropriate conduct or any act encouraging, concealing, conspiring, or colluding in any of the above actions are also considered as fraud. As technology has advanced and individuals conduct more and more transactions digitally, our personal details and online profiles have become critical. Identity theft, cybercrime, personal data theft, and associated crimes have ballooned into a significant global problem, and these behaviors are often undertaken in order to commit fraud. As such, best practices to avoid harm from cybercrime or data breaches will also help minimize the opportunity for fraudsters to be successful within your firm and with your clients. Best practices include maintaining strict security protocols, allowing access to only approved persons, that is, those with a serious business necessity to access information, regularly requiring password changes, ensuring other information, for example, contact details, reference data, is up to date, or limiting the ways important repositories of information can be accessed. While this module will not cover IT aspects of securing important information, using well-tested technology and taking common sense measures can often go a long way toward protecting an organization against cyber-enabled fraud. While you might expect fraud to be easy to detect, there can be gray areas. For example, potential conflicts of interest may be allowed as long as they are seen as relatively minor and are properly disclosed to the relevant parties. Local laws and regulations may deem certain activities legal in one country, which are illegal in others. Corollary to many fraud statutes is the crime of conspiracy to defraud, whereby a person conspires to deprive another person of something of value for which they may be charged, whether or not the fraud is actually committed. Fraud causes hundreds of billions of dollars in losses each year for both the public and private sector. While fraud will always occur, some common sense actions can be taken to lower the number of cases, and when they do occur, detect them earlier to mitigate the damage. Policies and frameworks can only address the most obvious types of fraud. Building a culture of integrity and accountability within an organization is also a critical element in reducing the harm done by illicit activities. While many firms fail to adequately support non-revenue generating divisions, such as risk management and compliance, the losses from incidents of fraud and corruption will often far outweigh the operating costs of those units. It is necessary to place competent and knowledgeable individuals in the key roles of compliance and internal audit, and to make sufficient resources available for them to carry out their functions. Senior management should develop a solid understanding of best practice and study past examples of fraud cases in order to guide policies and protocols which can then be put in place. Numerous tools and information resources are available to help guide managers when designing the risk management framework and internal controls, while emerging technologies such as big data, AI, and ML are also becoming increasingly important in combating unethical and illegal behavior. Thank you for watching.